Welcome to Step 3, how the world's best investors use rules-based investing systems in their portfolios. This is the third video in the How to Protect and Even Grow Your Portfolio series. So let's get started. First, just got to display some disclosures. I'll just leave these up. Again, pause them if you'd like to check them out. So who are the world's best investors? Today we're going to cover how they invest, and many of the world's best investors utilize what's called a quantitative investment process. We covered a little bit about this in the last video, but I'll recap. Quantitative essentially means that it's expressible as a quantity. So we can use accounting terms, price moves, things of that nature that you can get off of balance sheets or the price action from the markets, and then extract information out of them. And when you do this in a systematic fashion, you have a very repeatable and rules-based process by which you can invest. And as I mentioned, some of the best investors in the world utilize quantitative investment processes. First investor we're going to profile is Ed Thorpe, who holds a PhD in math and a near PhD in physics. And he created the first successful quantitative hedge fund in the world, Princeton Newport Partners. Now, Jack Schwager, in his book Hedge Fund Market Wizards, points out a number of Thorpe's achievements. During Thorpe's career, he was a first in a number of different categories. While working at MIT, he and another professor, Claude Shannon, developed the world's first portable computer. The only reason they invented it was to beat the game of roulette, as it calculated the odds of where the ball would land. He also developed the world's first blackjack betting strategy that gave the player a positive edge over the house. He detailed the strategy in his best-selling book, Beat the Dealer, which changed the way casinos played the game of blackjack forever. Most card-counting strategies are based on his systems. Thorpe and a colleague, Sheen Kassouf, developed the first quantitative strategy that traded warrants and other convertible securities by hedging them with the positions that they would convert into. And the pair detailed this strategy in the book Beat the Market. He then went on to develop the first options pricing model around 7 years before Black and Scholes developed theirs. But instead of releasing it to the public, he figured it was better to keep quiet and make money for his investors. He was also the founder of the first market neutral fund, as I mentioned, the first successful quantitative hedge fund, or quant hedge fund. First to implement convertible arbitrage, first to implement statistical arbitrage, and he was likely the first person to uncover that Bernie Madoff was a fraud, almost 2 decades before Madoff was actually apprehended. And so he uses a completely quantitative investing system. And between the years 1969 and 1988, a total of 230 months, he had 227 winning months, and he only had 3 losing months. And all of those losses were under 1%. That amounted to an annual return of 19.1% between 69 and 88, and an annual return of 20.1% between 92 and 2002. And in the late 2000s, he changed his strategy up a bit and started to use a trend following strategy to great success, but never launched a fund to trade it because his wife took ill. We'll cover trend following and tactical asset allocation later in this video. Now, what can we learn from Thorpe? There are numerous things that we could learn from Ed Thorpe. He was a very intelligent man, ran a very successful fund. But one of the things that was most important was that Ed Thorpe was extremely risk averse, having grown up during the Great Depression. So he focused primarily on investing that could reduce his risk. And he chose quantitative investing because he could have an idea of statistically his win-loss probabilities. And within a quantitative system, if it's soundly designed and well tested, you can see what your likely risk is. Of course, you don't want to go full force and bet the maximum. That's one of the things that he always cautioned against. But once you have an edge, and you have a specific risk tolerance that you'd like to target, you can build a quantitative system around that. And so the fact that he used a quantitative system is something that we can learn from and implement in our own portfolios, even if we don't emulate his exact processes. Next up is Jim Simons, who you may never have heard of, but he's one of the best investors in the world. He started the Medallion Fund in the 1980s after achieving a PhD in mathematics and becoming an NSA codebreaker in the 1960s. He uses techniques such as genetic algorithms, which are computer programs that learn through an evolutionary process, to systematically invest in the market. And he famously only hires PhDs. And as you can see on this chart here, he's down in number 16 during the financial crisis, during which period he earned an 80% return in 2008 and in 2009 a 38% return, when, of course, markets around the world were doing quite poorly, having the worst recession since the Great Depression. Now, his fund has been closed for years, with only around 6 outside investors currently in the fund, and the rest are the employees of the fund itself. But previously, to invest in this fund, you would have had to have at least 20 million or more, and there's some astronomical fees that we'll cover in just a second. So what's interesting is that, of course, he uses a quantitative or systematic trading system. So as he says here, we decided that systematic trading was best. Fundamental trading gave me ulcers. Fundamental trading is essentially using the manager's subjective research about a company in terms of how the management is, what they believe their prospects for a specific company or a specific trade is going to be in the future. And you can't exactly test that through a number of different periods. So you're relying on the manager's ability to continue in the future making those correct calls. Systematic trading is emotion free in terms of at least how the formulas judge the markets, and so you have a repeatable process by which you can have some expectations in terms of risk and return. His fund achieved an annual return of 35% from 1988 to 2009, which are the period where the numbers are available. And here's the interesting thing. The 35% annual return, that was after a 5% asset and 44% performance fee, which, if you do the math, is around an 80% fee or an 80% return per year prior to fees to get the 35% after fee return. So the Medallion Fund has done astronomically well and has made almost all of its investors fabulously wealthy. In the 1990s, George Soros had a return of 1,710%. That's the cumulative return. Whereas Jim Simons returned close to 2,500% during that period. Astronomical numbers. That's around 29.4% a year in fees or in returns for George Soros, and 34% per year after fees for Jim Simons. And I point all of this out to show you that many of the world's best investors use quantitative, rules-based investing systems. So they do this for the ability to thoroughly test their systems and develop an identifiable and repeatable edge over the markets. And it's likely to be repeatable because it's a system that's based on market patterns or factors, rather than the intuition or subjective research of a fund manager. And if you test the rules correctly, you can tell how repeatable they are across many market environments and many decades. So you can look at all of the many decades from the Great Depression to the financial crisis to the 1980s to the 1970s with stagflation, and see how your system may have done in those environments. And you can also test it in other countries during their own unique periods, because most strategies that you test, you want to have them be timeless and universal. James Montier has a great quote. It goes like this: in investment, we have no control over the outcomes. The only thing we can control is the process. So it makes sense for us to concentrate on that. Now, James Montier has done a lot of compelling work on behavioral investing, and it's fascinating that most people focus on the outcome. of a decision, which is called outcome bias, rather than the process by which you make that decision. And so when you focus on the outcome rather than the process by which you make the decision, you start to make decisions differently. For professionals, this involves focusing on short-term performance rather than long-term performance and choosing stocks that they can easily justify to their clients, but may actually be a bad value and will not add much higher returns over the long run, as would a uh, stock that may offer a better opportunity but may be less justifiable. So he has a great chart on the next page from his book Value Investing, and it goes like this. Here you have good outcomes, good processes, and bad processes. If you have a good outcome and a good process, well, you have a deserved success. If you have a good process and a bad outcome, you just had a bad break. That happens all the time. You have these great systems that underperform for periods, which is why they continue to work for a long time, because a lot of people would abandon them then. Then, of course, you have those that have a good outcome but a bad process. This often happens during bull markets where people that may not know exactly why they're buying a stock, they just have seen it has gone up a lot. They might be watching CNBC and they choose a stock and they think, wow, this is really easy. I bought this stock, maybe it doubled in price, or they got a 25% return over a small period of time. That often is just dumb luck and it's not repeatable. So the next time that they invest, they may try to do that same thing, but because it's not a good process by which they made the decision, they're likely to have a bad outcome in the next round. Then, of course, a bad outcome and a bad process, poetic justice. It is a deserved mistake. And if you start to think about what my processes are and divide that from what the outcomes are, you start to develop a better investment philosophy, because by focusing on the process, you can create a repeatable, systematic investing process by which you have a much better idea that in the future it's likely to do much the same as it has in the past. This reminds me of a great quote by Sir John Templeton. The time to reflect on your investing methods is when you are most successful, not when you're making the most mistakes. Most of the time, when people focus on the outcome of their process, they will abandon their investing system when it's underperforming relative to the market. That's not at all the time that you should do that, because you're acting on emotions. And so it's important when you're committing to an investment process that you look at the long term, that you stay focused on the long term, because there will be periods of short-term underperformance. We're going to go over some ways where we can lessen the likelihood of that, but it's always something to keep in mind. So without further ado, let's start looking at how the best investors diversify to prevent, or at least minimize, the likelihood of massive losses or underperformance for long periods of time. So how do the best investors diversify their portfolio so that they reduce risk in their portfolios while still capturing much of the market returns? Well, first of all, the best investors diversify using multiple asset classes and multiple strategies that have a low correlation to one another. Now, correlation is a measurement that's used to measure how much things move together. Using assets and strategies that have a low correlation simply means that those assets and strategies move differently than one another. Basically, this means that when one zigs, the other zags. And many advisors and investment managers out there will simply spread an investor's portfolio across several different asset classes, like the S&P 500, large cap growth stocks, small cap stocks, international stocks, and real estates. The problem with that is that most of these asset classes move together at the worst times. For example, during a recession. So what we also want to highlight are assets and strategies that have different return drivers. They're not only move differently through time, but you're going to diversify because the factor that is driving its returns is different from many of the other pieces in the portfolio. Good example of this are the Harvard and Yale endowments, and they've made great use of multiple asset classes with higher risk return profiles to generate substantial returns over the past few decades. Yale's endowment has returned 16.4% per year since 1985, and they pioneered a lot of the use of alternative asset classes in their portfolios. Harvard hasn't done as well, but they've done quite well. Um, After all things considered, they've had 12.6% returns since 1985. And the success of these two investment programs with the tens of billions of dollars under management has led to this strategy being called the endowment strategy. And the endowments invest in strategies and assets with higher expected returns than the normal markets. Things such as venture capital, private equity, actual real estate, not real estate investment trusts, timber. They'll buy just huge swaths of land that have a lot of timber on there. They'll invest in hedge funds, funds that specialize in buyouts. They'll, of course, also still invest in U.S. stocks, foreign stocks, and they'll also add a lot of commodity and possibly currency exposure to there. Now, this does fantastic when the markets are on an uptrend, but as we saw in 2008, it can sustain substantial losses during a time period like the financial crisis, at which point both Yale and Harvard experienced significant losses. So, while we may not have access to all of the asset classes Harvard or Yale do, there are numerous public investments we can use to replicate much of what the endowments do. The returns might not be quite as good, but with the right growth assets and some risk management, we can replicate the diversification across growth asset classes while hoping to avoid the times when the endowment strategy does poorly. If you look at the graph of the various public asset classes over the past 4 decades that an average investor has access to, like the one pictured here, you can see that a diversified portfolio of growth assets would have added significant risk reduction. Many of the assets zigged while the others zagged. Things like commodities and real estate didn't exactly follow the rest of the markets precisely. However, during the past 2 decades, we start to see the asset classes move more in tandem. This is due to globalization. The world markets are much more connected than they ever were before, and the financialization of asset classes such as commodities and real estate, which causes them to move much more like stock markets. Now, if you focus on the period I've highlighted in that pink box up there, the financial crisis, as an example, we can see, if we zoom in on that period, that the growth assets that previously offered low correlation to one another now will move in tandem, offering little in the way of risk reduction during the period when we need it most. So let's focus in on a few asset classes that have traditionally had low correlation to one another and see how they did during the financial crisis. Here we have in blue how the asset class did historically versus U.S. stocks, how correlated it was to U.S. stocks, and then how correlated it was during a period of financial stress during the financial crisis. And as you can see, everything from real estate to international stocks to emerging markets, commodities, and even U.S. bonds, they all became more correlated to stocks during the financial crisis, which is precisely when diversification, in its traditional sense, was supposed to help the most. But at that time, the risk reduction wasn't there. So if we just take a few of these asset classes and apply some risk controls, we can start to create better diversification and help us avoid those points at which diversification, the traditional type, where we just buy a bunch of different assets, when that fails. So let's focus on U.S. stocks, international stocks, commodities, real estate, and U.S. bonds. These are often called the core 5 asset classes. And here they are during the financial crisis. And we can see that the growth assets moved the same during the crisis, but bonds maintained a fairly steady value throughout the crisis and even gained some. Now, this low correlation between stocks and bonds is what created the traditional 60/40 bonds retirement strategy in the first place. But the 60/40 portfolio has some failings, and it only slightly reduces risk as compared to an all stock allocation, as you can see here. It only reduces the loss from around 51% to around 33%, which is still a large loss to incur in your portfolio. So instead of holding a static allocation to stocks and bonds, let's dynamically allocate them based on a rule. A simple moving average rule can help us reduce risk dramatically. If you recall from video 1, a simple moving average just takes the average price of a time period, say 10 or 12 months, and if the current price moves below the average price, you get it out of the asset class. And you can see that pictured here. And that's how these asset classes in the portfolio would look once simple moving averages are implemented to reduce risk in the portfolio. This shows that at the point where the asset class would have fallen below its moving average, it just goes to cash. And this allows us to take advantage of the diversification across the multiple growth assets during bull markets while reducing the risk during catastrophic market moves. And in the next few slides, we're going to start incorporating this into the portfolio. So we're also going to compare two types of portfolios to U.S. stocks and eventually the tactical asset allocation portfolio. One of them is a traditional 60/40 stock portfolio that has 30% U.S. stocks, 30% international stocks, and 40% U.S. bonds. And then an equal weight portfolio that simply puts 20% into each of these asset classes: U.S. stocks, international stocks, commodities, U.S. real estate, and U.S. bonds. And we can see those pictured here. As you can see, U.S. stocks and the equal weight portfolio often move in tandem with one another, with the equal weight actually doing better and offering some more diversification in a lot of different scenarios. And that's just a simple, naive strategy of just equally weighting five asset classes. And then we have the 60/40 portfolio, which has that constant allocation of 40% to bonds, and we can see that it lags both of the other two for a lot of the period and still maintains that large loss in the financial crisis. If we look up here at returns, we can see that the U.S. stocks lead, but the equal weight portfolio does a much better job of keeping up with U.S. stocks, but it also has a similar maximum loss in the portfolio, and that's all that maximum drawdown means. What the maximum peak of the highest high of your portfolio to the lowest low. And U.S. stocks clocking at negative 51% during the financial crisis, and the equal weight shaves off about 7% of that. The 60/40 portfolio drops that down to negative 34%, but of course that's still a very large loss. And here's the interesting thing though. The 60/40 portfolio is almost 98% correlated with the returns of U.S. stocks, meaning most of the variation in the portfolio's returns are attributable to U.S. stocks and not the bond portion of the portfolio, whereas the equal weight portfolio somewhat more diversifies that return stream by only being 82% correlated with U.S. stocks. And the equal weight portfolio also creates a situation where you have more positive months, 67% versus 65 and 62% for the others, and more positive rolling 12-month periods, so more positive years, 86% of years. Now, let's see how we can improve upon these portfolios in risk reduction terms by adding in those moving average rules. And here we have the tactical asset allocation portfolio in blue that uses the risk management techniques that we've been discussing. And it's labeled the Core 5 TAA, which stands for Tactical Asset Allocation. And as you can see, it is a much smoother growth curve where it helps avoid most of the largest drawdowns, most of the largest recessions, while maintaining decent returns throughout time. Now here, if we focus in on that pink box again and look at the financial crisis, we can see that it avoided the losses of the other three portfolios, which were US stocks, equal weight, and the 60/40 portfolio, by simply exiting those asset classes when the markets went down and going to something, say, like bonds, or if bonds became risky, just simply going to cash. And this allows us to take advantage of the growth assets during bull markets, but have a much more steady ride when the markets start to get choppy. So if we look at the risk reduction that the portfolio achieves, it offers comparable returns, and the Core 5 is featured with 1.5% fees when you add up a simulated advisory plus transaction costs. After those fees, it equates to the annualized return of the 60/40 portfolio, but with much less volatility, so much less fluctuations in the portfolio, a much higher risk to reward ratio in the Sharpe ratio, and then finally a drastically lower maximum drawdown by using those trend following techniques, by using those simple moving averages to help reduce risk. This also decreases the correlation that the Core 5 portfolio has with US stocks, meaning it might not always go up or go down at the same times, which is what you want when you're reducing risk in a portfolio and diversifying. We're diversifying with this not only across asset classes like we did with the equal weight and 60/40 portfolios, but with those different risk reducing strategies. This increases the number of positive months from 65% for the 60/40 portfolio to around 73%, and the number of rolling 12-month periods, so rolling years, from 82% positive to 94% positive. And so that lower correlation to US stocks shows us that we did reduce risk a lot, but you have to remember that correlation means how much it's going to move with the markets. And so we're going to cover this some more in just a moment, but this leads to a drastically different pattern of returns than you might see or expect in US stocks or a buy and hold portfolio. Up next, we have Ray Dalio. He is the head of the largest hedge fund in the world, Bridgewater Associates, with around 169 billion assets under management. And he created what was called, and what is still called, the all-weather strategy that utilized a diversified return stream. And the all-weather strategy is based around the principle that different asset classes act differently in different market environments. Therefore, by balancing asset exposure and asset classes, the funds can outperform the traditional 60/40 benchmark with less risk. Now, all weather is designed to perform across all economic environments. So let's pull a few plays out of Ray Dalio's playbook and see how we can incorporate them to our own portfolios. Also, if you have not yet seen his video about how the economic machine works, it is a fascinating video, and I recommend you watch it. It will get you up to speed on a very solid framework for how the U.S. economy works and how we should start to think about our economic policy in the future. All right, so Ray Dalio has some great quotes, and here's one of them right now. It's always a matter of controlling risk. I'm always trying to figure out my probability of knowing, and given that I'm not sure, I don't want to have any concentrated bets. We live in a world of a lot of uncertainty. It's almost impossible to predict what is going to happen tomorrow or next month exactly in the financial markets. So we don't want to be too concentrated in any one asset class. Let's continue to diversify our assets and our strategies. But first, let's take another look at the 60/40 portfolio. So again, it only reduced risk from 55% or 51% losses to around 33% losses in this particular variation. And so that's not a huge risk reduction. And if we look at it, oftentimes the portfolio allocation, and so say we do a 50-50 portfolio allocation between stocks and bonds, most of the risk, maybe 90% of the risk, would come from the stocks in the portfolio. And so you have the value of each that you're investing in is only 50%, but stocks produce 90% of the risk. So what can we do to help improve the risk return for the bonds part of the portfolio? Dalio's solution is to use leverage to increase the exposure to bonds so that they have an equal risk exposure in the portfolio as do stocks. And this actually increases the returns of the portfolio while simultaneously reducing the overall risk because stocks and bonds are affected differently by moves in the economy. Just by doing this one simple tweak to the portfolio, it helps us create a smoother ride. So let's introduce another variant of the tactical asset allocation portfolios, this time using the concept of risk parity, which is to equalize the contribution of risk between risky and less risky asset classes. In these cases, the various growth assets and 10-year treasury bonds. And as you can see, it produces a much smoother curve of growth compared to either the 60-40 portfolio or the equal weight and U.S. stock portfolios. And if we look at the risk parity statistics, we can see that it too reduces maximum drawdown much greater than the 60-40 portfolio using a different methodology than the one we just looked at, and also improves the amount of positive months and years to 73% and 97%. And it does so while only having a 30% correlation to US stocks, meaning it is going to be moving and creating a return stream that is much different from any of the stocks that you may hold in your portfolio. However, one of the cautions regarding risk parity is its reliance on treasury bonds to reduce risk and increase returns in the portfolio. Now, over the past 30 years, bonds have been the largest bull market in U.S. histories, as interest rates have decreased from the mid-teens in the 1980s to the low digits today. So during a falling interest rate environment, risk parity works really well. And during a rising interest rate environment, however, treasury bonds offer lower returns and higher risk. And this makes the risk parity approach a little less robust. So that's a challenge that we'll have to look at going forward. And there's actually a pretty cool solution that we can look at in just a moment. But first, let's look at some of the benefits and drawbacks of this methodology. So if we look at the various times at which there's been recessions and losses in the stock market, we can see that both the Core 5 tactical asset allocation portfolio, just labeled Core 5 up at the top, and risk parity offer good diversification and sometimes even positive returns during down markets. If you look at the 70s up here and then 1990, the early 2000s after the tech bubble burst, and during the financial crisis, all years they were able to protect or even grow the portfolio. However, with these strategies, there's a little bit of a drawback. Ever since quantitative easing started with the Fed printing money to help stimulate the economy, things have become a little distorted for these strategies. So if we look down here, we can see that they've dramatically underperformed over the last few years. Now, this is typical for any different strategy, and it offers us an interesting solution. Most people want to find one investment strategy that works. But as we see here, they don't work all the time. Now, why is that? Well, 90% of what passes for brilliance or incompetence in investing is the ebb and flow of investment styles. First, we need to realize the perfect strategy doesn't exist. There will always be an opportunity cost in using different strategies. That's because no investment strategy performs the best in every economic environment. No single financial strategy, whether it be quality investing, high growth investing, value investing, or tactical asset allocation, will perform the best in every type of market. There will be times when it underperforms and other times when it will outperform. Fortunately, there's some good news. You can improve the consistency of your portfolio by following some simple guidelines. So, if different investment styles and strategies outperform and underperform over different periods, and risk parity offers a very compelling framework for reducing risk and increasing returns, why not combine the two? We'll cover more about this in the last video, but utilizing a multi-strategy portfolio prevents us from relying too much on the return stream of any single strategy. And using risk parity to allocate across strategies makes it so we don't have to rely on treasury bonds to power the portfolio's returns. We can rely on different strategies to help us equalize the risk and return. Therefore, I believe a better way is to use a risk parity framework and allocate across multiple strategies rather than multiple asset classes. So if we look at the various periods throughout this multiple last 4 decades or so, these multi-decade period, we can see how the multi-strategy portfolio helps us reduce risk and still maintain returns during bull markets. So up in the early 70s, there was a lot of problems in the economy, and there, of course, was a recession during those first early years. And as we can see, the risk parity and core 5 portfolios dramatically underperform in some years, while offering a lot of downside protection in others. Whereas the multi-strategy does a much better job of reducing risk and keeping pace with the 60/40 portfolio. Now, in the late 70s, it starts to outperform, as it does also through the early 80s and all throughout the 80s. Does a very good job there in both reducing risk and maintaining a very good return target. Then in the 90s, we had some recessions in those early years in 1990 and like 1994, and some market pullbacks at the very least. And as you can see, the multi-strategy does a good job of keeping pace and reducing risk of the portfolio. In 1990, actually making a profit when the 60/40 was down a bit, and 1994 underperforming a little bit, but that's okay. It's one of the few calendar years where it does that, and maintaining or exceeding the 60/40 portfolio in some other years. Then in the late 1990s, this is a time period where a lot of tactical asset allocation strategies, because they weren't all in the stock market, underperformed a lot, and the multi-strategy does a pretty good job of keeping pace with the 60/40 portfolio, which was, of course, invested in one of the best bull markets in history. Then in the early 2000s, it provides a lot more risk reduction, actually making some profits during those tough years right after the tech bubble burst, and then continuing that trend throughout the 2000s up until the financial crisis, offering much more consistent returns than either core 5 or the risk parity and the 60/40 portfolio. Then during 2008, it was about flat. Risk parity did a great job of making profits during that period because it was levered and heavily invested in U.S. bonds, which did very well then. Whereas the 60/40 portfolio, as you all remember, would have had very large losses. Then in the period after that, where core 5 and risk parity struggle so much against the 60/40 portfolio, the multi-strategy does a pretty good job of balancing out its risk reduction with staying in the bull market. And so it helps reduce a lot of the problems that the core 5 and risk parity portfolios have during this type of environment, because it allows it to allocate to other types of strategies. And so it maintains the risk reduction inherent in using a multi-strategy allocation while still allowing you to have pretty good returns throughout those periods that are much more consistent than some of the other ways to reduce risk. while of course not making quite as much as a buy and hold portfolio, but the buy and hold is at risk during the next recession. So let's look at some of the pieces that go into a multi-strategy portfolio. So several of the strategies that you can include in a multi-strategy portfolio are value stocks. Basically, value investing is buying something for less than it's worth. Momentum, which is buying stocks or asset classes that are continuing to go up in a trend. Macro investing involves looking at the different macro economies of the world and how they play with one another, or possibly looking at a single economy and determining whether the strength of the economy justifies investing in that stock market. Quality stocks involves buying high quality companies that have strong earnings, maybe an economic moat that prevents competitors from entering the market, or they have strong growth in their earnings potential. Risk parity, we talked about, where you equalize the risk across many asset classes by levering things up. Size, small stocks tend to do better than large stocks. Activist investing involves following some of the activist hedge funds into their trades. Essentially, an activist hedge fund will launch a PR campaign after taking a large stake in a company, and they'll either try to get the company to merge with another company, get it acquired, pay out a lot to the shareholders if the company's not using the shareholders' dollars well. And they do this by replacing people on the board, replacing CEOs, getting the company to follow new plans. There's a lot of different ways they do this, and you can follow them into their trades. And we'll talk about this more in the next video. Currency, different currencies have different interactions based on what is going on in the economy in any given year. For example, over the past year or so, the US dollar has been strengthening against world markets that many of whom are on the brink of recession, or they are devaluing their currency to try to boost their economy. So currency plays are typically have a low correlation to the rest of these assets, and that low correlation is what we want. Same thing goes with low volatility stocks. They offer oftentimes lower correlation to the overall stock market than just individual stocks. And you can use that to help reduce risk. And really, low volatility stocks typically have higher returns and lower risk than high volatility stock. And of course, commodities. And commodities are things like oil, cocoa, cotton, and precious metals as well, like gold or silver. And you can invest in a methodology to invest in that has a very low correlation to a number of these other strategies. So in the next video, we will talk about how to properly diversify your portfolio by using multiple systematic investing strategies. We're going to go more into the multi-strategy portfolio and expand upon that topic while talking about a lot of the individual strategies that are collected to create a really robust portfolio solution. If you liked this video, feel free to shoot me an email via the contact form on my blog, or leave a comment below this video. I always like to hear from viewers to see if this has provided you a lot of value. I hope it has, and I will see you in the next video.